Welcome to Koch Capital's Retirement Funded Ratio presentation, the one number every retirement-seeking investor should know and manage. Hi, I'm Jim Koch, the founder and principal at Koch Capital. Before we get started, please take a minute to review these important presentation disclosures. Okay, for this presentation, we're going to start with exactly what is the funded ratio, how the funded ratio is calculated or derived, how to use it for retirement income planning, what are its benefits and limitations, and to make this educational video easier to follow along, here is where you can get the slide deck if it's easier to go along with the slides as opposed to watching the video or doing them both concurrently. I've made the slides available here. So let's start with a funded ratio definition. It's basically all your assets is the numerator divided by all your liabilities, and if that number is greater than 1, then you have enough assets to cover your liabilities. We're using that in the context of a household balance sheet where you have all your financial assets on the left, and I'm showing them here in the green, as well as all your living expense, your liabilities on the right, which I'm showing in red. And if you divide those two, which I'm doing down here at the bottom, and if that number is greater than 1, or sometimes you'll see it presented as a percentage, then you have enough assets to cover your liability and you're funded. So why this approach in the first place? Well, the number one reason that I've found, and this is what we're going to explore a lot in the presentation, is it's comprehensive yet flexible. And I mean very flexible. You can really set this up to work in a way that's best for your situation. This is not any type of old technology. This has been around for a long time. The pension plans and stuff have been doing this type of balance sheet and using the funded ratio for years. So there's a lot of good research and stuff behind it. And also I just find it tends to be a pretty intuitive type model to use. In general, folks understand, assets and liabilities, and that you always need more assets than liabilities to remain solvent. And finally, the kind of the new twist on it is, and you'll see up higher, I've used the word collaborative for balance sheet, and that is in this day and age where we can share a lot of this stuff and have interactive sessions, and that it really becomes more of a collaborative approach with whoever you're working with. And as I find it really gets your clients much more involved in the process of planning, especially when they're right there and can work with you and see the exact same thing that you're seeing, as well as contribute to it. So these are the reasons that Koch Capital has gone to this approach. You'll see any number of types of retirement income strategies. The general name for this one is the funded ratio management, and this is from the folks Fowle and Cooper, who wrote a big paper on various strategies. Even though they put this in the middle, the nice thing about it is flexible, that if you want to go to more of a probability based approach, and what we mean by that is you're more dependent on volatile assets and you're making a prediction in the future where those are going to be, you can go more that method. Or if you want to go more the safety first method, where you're building basically a very secure guaranteed income floor with annuities and bond ladders and that, on top of your Social Security, you can go that method too. So again, this is a flexible architecture that can walk kind of in multiple camps here, whatever the preference of your client is in terms of how much risk they want to take on versus a very safe type approach. We'll talk more about that a little later. First, let's get the mechanics out of the way and talk a little bit about the various asset categories and then the liability categories. So first up on the asset side is current financial assets. Those are ones that you know about, your IRAs, your 401ks, your bank accounts. The nice thing about those is the fair market value, the prices daily on those, because they reset virtually daily. Then we have another category that we call current real assets, and those things tend to be the things that are a little bit harder to price on a daily basis, and they could include private businesses, rental properties, all this different stuff that We wouldn't categorize under as a financial asset, but it's a real asset. Next up is future savings. So this is kind of a bucket. You can think of this as especially if you're younger, this is how much you're planning to save for retirement. It also could be additional labor income when you're in retirement. But we're trying to map out here is how much are you going to be saving in the future that we can count on and include it in your list of assets. Next up is what we call pension income. Now we're getting down to more safe income-based sources. So this, for example, would be any type, if you're lucky enough to still have a defined benefit pension, annuities, we put life insurance in that area, individual government bond ladders. So you're buying individual government bonds to help fund. And then the final category we call is what is kind of true guaranteed income. And for that we use primarily Social Security is the one that comes to mind, but there's also other federal government guaranteed pensions as well. But Social Security by and far is the most common one, and what we're really referring to with this particular category. So if you look at all these asset categories together, here's how we're grouping them. We're basically having the more risky ones in the lighter greens down to the more guaranteed or less risky or safer sources down at the bottom. Another way to think of these risky versus safer assets is in terms of, you'll hear these terms sometime, financial capital. Human capital is more your ability to earn money and save. So that's primarily for the future savings bucket, but it also can creep a little bit into either current real assets or pension income. And then social capital is basically Social Security or things where you have a third party, a secure third party guarantee on the particular asset. And what you can kind of think of it is, and this is the parlance of the Retirement Income Industry Association, RIA, is you can think of the first three buckets being kind of more your risky upside, and the two bottom buckets being more of a secure type investment. So that's the distinction that I just want you to keep in your mind as we move forward here. Okay, so if that was the asset side, now let's look at the liability. And let me just say this is the part that really takes a lot of work to do well, but it's well worth it. And frankly, this is the whole reason that my firm went to this approach, is because right here we were just having a hard time modeling expenses out into the future with just the existing software applications that are out there. And the reason why is, man, all the expenses are very, very different. You can think of, for example, like essential living expenses, food, water, shelter. While that may increase a bit with CPI, as I'm showing in this particular example, not all expenses follow that particular route. Especially medical expenses is the really tough one, because early on in retirement, medical expenses are usually not too bad, but then you have a big ramp at the end, and it definitely ramps up faster than the normal CPI inflation, and at least that's been the case. And I'm of the opinion that's not going to change. And then whereas something like discretionary expenses, the fun stuff that you get to do beyond your essential expenses, in retirement, folks tend to spend more early on, and then that time tends to taper off, which is why we call it the ski slope. And I'll talk a little bit more about taxes here in a second. But being able to get the nuance of those expenses over a long-term retirement period, I just found I could do that better if I could break out the individual components and model them separately. And basically what it really is coming down to is you're building a much more nuanced budget as opposed to just kind of a general guessing what the expenses are going to be in the future. Okay, with that in mind, let's go look at the expense side buckets. The first one up is what we call lifestyle living expenses, and these are really discretionary expenses. These are the types of items that you'd really like to have in retirement, but you could live without them if you have to. Next up is we kind of group legacy and college funding together. Also, obviously, it could have charity in it. Those are stuff too that you would like to be able to fund, but if push came to shove, you don't have to. Tax expenses is interesting. We break that out separately. I would consider it an essential expense, but it's something that where an advisor can actually add a good amount of value is by really being on top of the expenses and stuff, because you can, and the problem with taxes is they can be very unpredictable if you don't plan for them. If you sell a business or inherit some money, or have done incorrect estate planning, you can get real bumps in any given year that draw down a fair amount of cash, and you really want to be prepared for those. And that's part of the reason that we break out again taxes by itself, is so that we can, we want that to be front of mind of both the advisor and the client, and again demonstrate that the advisor can add value by keeping those to a minimum. And again, since it's broken out in a separate bucket, you're going to know real quick whether or not you're doing that or not. Then the next bucket is the medical expenses, and again, that was one of those expenses that doesn't follow just straight CPI. It goes up faster CPI, and it really ramps up at the end. We use a service to map those out called Health View Services, and they will, based on your age and some preliminary medical background, they can look at what the average is in terms of your out-of-pocket expenses, and it's usually pretty daunting. And this is the one area where I don't think enough people really plan for medical expenses, especially late in life. So that's another reason why we break it out, even though it is part of what we would call an essential expenses, and then everything else is what you traditionally think of essential or mandatory type living expenses: your food, shelter, transportation, and clothing. So those are the main categories. So let's now talk a little bit about them in aggregate, and the way we're grouping those is, again, the lighter reds and stuff are more your wants, whereas when we get all the way down to tax, medical, and essential, those are really your needs. Those are the things that at a minimum you have to be able to fund. Okay, so let's put the liabilities together with the assets, and this is the side-by-side comparison we're looking at. Again, on the asset side, we're looking at the higher risk assets down to the less risky assets, and then from your wants, your discretionary, your lifestyle type expenses, down to the ones that you absolutely have to fund. And what we're trying to do in terms of managing the retirement risk is really match your risky assets with your lifestyle liabilities, and your safe assets with your essential liabilities. And there's varying degrees of how to do that. If you're very risk averse and have enough financial assets, you may want to have your safe assets cover pretty much everything. But there's different variations of that. Everybody's a little different, but this is essentially, when you use this approach, what you're trying to do. And it's a classic kind of asset liability matching type approach. Okay, so let's talk how the funded ratio works in this type of environment, because there's a huge time element involved here. This is a chart by David Blanchett at Morningstar, and what he tried to show here is kind of, if you think of retirement in three stages, kind of early, middle, late, that there's risks at all points in your retirement, but certain risks are more prevalent than others at different stages in your retirement. And early on, sequence risk, which is the problem if you're distributing from a risky portfolio. That's one that has stocks and bonds where the prices fluctuate, and you pull out money, or you need money to fund retirement when the stock market has a big decrease, then it's very hard to recover from that. So that's sequence risk, and that tends to be, the other risks are also factored, but that tends to really make it hard for an entire retirement plan if that happens early in retirement. Middle retirement, inflation risk. We haven't seen much inflation risk recently, but when you're well into retirement, your assets have been drained down a bit, and if we go into an inflationary period, inflation can really bring down the purchasing power of those remaining assets. That's why you need to have at least some assets that play well in an inflationary environment, and we'll talk about that. And then of course there's always the risk later in retirement that you live longer than you plan, and that's what we mean by longevity risk. And now we're going to explain a little bit how this approach, using the funded ratio, can really help you plan for that. So the idea is to start thinking more about managing outcomes, and how do we make each of these three stages of life be smoothly and fully funded. I'm going to start from the bottom here with the guaranteed income line. Remember, guaranteed income is basically Social Security, and one reason that it is such a desired asset, an income producing asset, is because it actually deals with the three main retirement risks. There's no sequence risk because the price isn't fluctuating. There's regular annual bumps into it, so for inflation, and it lasts exactly the duration of your lifespan. So it is an ideal asset class to have in retirement. What most people are dealing with is that they've got financial assets, right, and probably also some real assets before they go into retirement. So say if you're you're not in retirement, but you're getting close, so you're before retirement and you have these buckets. What you need to think about doing, or at least we're of the opinion, is possibly taking some of the financial assets and committing them to a much safer type of what we call pension income. So that might be a government bond ladder or whatever, but you want that to be able to get you through the first third of retirement. If you're really risk averse, you may decide to take all those early on and just commit most, or a good part of them, into very safe type income producing assets, so then you don't need to worry about retirement. But if you want to remain flexible, which is again what this household balance sheet allows you to do, you might be able to again fund the early part of retirement, and then say when we're getting toward the end of that, what you can do is look at your what's remaining in your financial assets here and what's in your real assets, and maybe take part of those and make another very safe income ladder to fund the middle part of it. And then so on. When you get a little further down the road here, you may want to decide it's time to get an income annuity or something. I mean, I'm just using I'm not necessarily recommending this approach or these products, but there's a lot of different things that you can do. And what the household balance sheet really allows you to do is have that flexibility to really think about where you are at any given time, and then select kind of the right product selection for your particular situation. Now again, you may want to go the ultra safe route and rebuild your safer pension income stream all in the beginning, or you may want to defer it and just see how your portfolio does and your current financial assets, and then make the decision when you're at various stages in retirement. So that's one of the reasons that we at Koch Capital really like this approach, is because again you have a lot of flexibility in selecting what's the best approach for the client. Okay, so let's go through an example so you can see how this would play out using our dashboard screen here. So I've got everything together. So say this is a younger couple that is still working to they don't have a house yet. Maybe they're saving for that. Most of their asset value is really in their future savings capacity, which we're mapping out, and we've taken a stab at figuring out what type of retirement they would like to have in terms of what their living expenses and stuff. And so what we find out is that they're under one. They're 80%, so they're not funded. But now this is the goal that we're moving forward with, and we can track this year by year and make sure that they're on course to actually meet that. So then let's look at the next case here. So say we get somebody that's near retirement, and again, I haven't changed the liability side. This is just purely a hypothetical for demonstration purposes here. But now they've got some more real assets. The future savings has gone down a bit. Their current assets have grown. Their Social Security has grown a little bit. So now we're showing that they're actually just got into being funded right there on the just enough assets to cover their liabilities. So let's go ahead and look at the next one. So when they're in retirement, they've actually accrued some more assets, but in this case, they've actually already taken some assets from the current finance side. Let me back up here. And for example, already committed them to the pension income to have a safer stream. And so remember, the whole reason that we're doing this is to get liability matching, because what we really want to do is, now if we go down here and look at the pie charts, remember we want to match as best we can the risky assets. I apologize, went forward there by accident. The risky assets, or excuse me, in this case, we're going to say the safer assets, where it's over here with their essential liabilities, and we've done a pretty good job with that. And again, if you want it to be even safer, you can commit more to your safe assets here, your pension assets, and guaranteed to get a higher slice of a pie like this, and just leave a little bit in your for investment that maybe you'll use later for bequests or additional lifestyle planning. So that's the idea, and how to use the pie chart is to get an idea of where you are in terms of matching your risky assets with your lifestyle liabilities, and more importantly, your safe assets with your essential liabilities. Okay, like all applications and models looking out in the future, there's some really big assumptions that we have to deal with, and by far the biggest one is mortality. When are you going to die? And couples, when both of you are going to die, in what order, and in between. And a couple of things to think about with this approach is whether or not you want to use, when you're looking at the cash flows of the liabilities, one way you can do it is this ANPV, which is called actuarial net present value, versus just regular net present value. Actuarial net present value actually puts a probability of a mortality prediction on, say, for in any given year, what's the probability you're going to be alive, and so that will actually reduce the expense a little bit if you're going that way, as opposed to using what I call in the second paragraph there a more date certain death calculation. I tend, at least at Koch Capital, we're trying to get away from more of the probability calculations, and we do use a date certain calculation based on the actual actuarial tables plus your health history and stuff. But the nice thing is, this is something that you need to, and should be anyways, monitoring with your clients all the time, because stuff happens, things change, especially when you get in those mid or late retirement years. You're going to have more information on the health of the couple, and you can change the assumptions and when death is, and it's just one of those things that you need to stay on top of. But that is the big variable pretty much in all these types of models, so it does need constant monitoring. Excuse me. The next is the discount rates. Boy, a lot of different ways to do this. Hopefully this picture will help. the main thing is to be able to do a spreadsheet type model. You need to get all the assets and liabilities in present value terms in order to do a fair apples to apples comparison. And there's a lot of different ways to do discount factors. The nice thing is, again, the household balance sheet lets you support any number of ways to do this. So the idea is that if you're using for current financial assets, we know the value of it, right? We know we know basically every day what's the value of your portfolio, for example. But some of these other assets, we've gone out into the future and they've created income streams. And the question is, do we discount those back a bit? And again, there's a lot of different philosophies about this. If you use, for example, the 30-year T-bond rate, that's going to be kind of the highest discount factor. That's going to make both any income streams out in the future look less than if you do a lower rate or don't discount it at all. Same is true with your expenses, where a 30-year T-bond rate is going to discount those expenses back a bit. So what we would do in general is say that the younger you are in this particular when using this application, and depending on whether or not you've got future for example, if future savings is your biggest kind of asset bucket at the time, we would use a 30-year T-bond rate. Then as you get closer to retirement, we go to a 10. When you're in retirement, maybe we use the risk-free cash rate. All the way to late in retirement, you don't need to do any discounting at all. You're all pretty close to, or at least that's our opinion. But there's a lot of different ways to do that, and it can be, and what's important is that whatever method you choose, you obviously can explain it to the client and the philosophy behind it. But again, the nice thing is the framework supports any number of ways to be able to do that. But that's another important assumption that you got to think about. The third one is retirement date. And that drives a lot of stuff. That really is, when do you take Social Security, when to build that first pension income tier, and you may have some gaps in the coverage of Medicare that you need to fund as well. So those are kind of the main model assumptions, with the biggie being mortality. You can control the discount rates and the retirement date. It's a little bit harder, obviously, to control your own mortality. Okay, if those are the assumptions, let's look at some of the tools that can help you, either as an individual or as an advisor, implement this type of household balance sheet solution. And the biggie, from my point of view, which keeps amazing me, is Google Sheets. So that's the Google spreadsheet program. Obviously Microsoft has its own, and there's some other ones out there, but being able to get a cloud-based spreadsheet that you can share with clients. Google has some special features that I really like. They have functions and stuff that you can call out and get, for example, current interest rate data. There's sites that you can go and pull the current Schiller PE CAPE ratio in. You can get current security prices, and there are ways to make it integrate with other account aggregation tools, so you literally can get account balances and stuff like that. So what you're basically doing is you're taking a product and customizing it enough that it does become a real-time application, and it just works great. I can't say enough about it. It works great in our practice. Happy to show how that can work if anybody's interested. The other thing I just found, having done this, is you got to think wide. We're working in spreadsheets over many years. Two things I've found that have been really helpful to do that is, one, the more wide format printers, which can print 11 by 17 inch paper. It's really handy sometimes to be able to get a big view so you can see the whole cash flow. Also, monitors these days, getting a more high def, wider resolution monitor helps an awful lot. And then the last part of it, more and more from kind of education purposes and how to use this and for your clients, is like what you're watching right now. I do some YouTube videos that are available to the public, but then we also have very specific videos that are private. We happen to use Box and then make specific clients have available to those so they can just view them from within Box. But more and more, I just find if you can do a video example of something, that's a lot better way to communicate the the solution or the issue or the resolution to a client than trying to write a long dissertation or explain to them over the phone without any visuals. So those are a couple things to think about. And again, why we call this Back to the Future is because it is a pretty amazing. We're back. Spreadsheets are really useful things. They always have been, but the new twist with them being available, cloud-based, where you can actually collaborate, makes them really useful. And the main thing, I think, in terms of the actual application, the household balance sheet approach, which is really funded ratio management, is you're getting more of an orientation to manage outcomes, not just investment risk. And that's the whole reason we're doing this. So I just want to point out again, it seems like for the past, and this is my opinion, for a long time we've been focusing just on this, whereas that really is just a small bit of your overall kind of asset pie, and then the ever important liabilities that you need to kind of figure out in life. So I'd just like to end it and say, know your retirement funded ratio and manage it prudently. Okay, if you'd like to learn more about household balance sheets in general and the funded ratio in particular, here's some great resources that will definitely bring you up to speed on them. I highly recommend them. And finally, here's my contact information. If you'd like to talk or learn more about my services, I work both with individuals that are near or in retirement, as well as advisors in terms of implementing these types of services. I can give you a look under the hood with a demo. There's my contact information. And again, thank you very much for your time and consideration. And don't hesitate to contact me if you'd like to discuss this further. Anyways, thank you again. Take care.